The company failed. How did this happen? $1.3 billion was erased. Shareholders lost everything. Pensions were damaged. Jobs vanished. Reputations shattered. At the center was a $30 million cash shortfall, a small number on a sheet, a crisis in the bank, a decade of hidden problems exposed in a week. For years, the business grew fast. Deals piled up. Acquisitions reshaped the balance sheet. Leadership chased scale. Control moved to the top. Decision-making grew private. Transparency thinned. Growth became the story. Investors bought that story. The share price rose. Executives were celebrated. Early employees and investors profited. That success masked fragile books. Then a choice was made. Accounts showed $29 million in irregularities. Executives chose concealment over disclosure. They smoothed the books. They delayed reconciliations. They rerouted cash flows across borders. They treated a discrepancy like a secret to hide. Why hide $29 million? To protect the share price, to keep deals moving, to avoid covenant breaches, to keep appearing successful. That risky choice worked briefly. Revenue numbers looked better. Market confidence continued. Liquidity stayed available. The company used its reputation to borrow more. Momentum reinforced risk-taking. Small victories sealed bigger bets. Leadership took on more leverage. Acquisitions became bolder. Internal controls were bent. Auditors relied on what they were shown. Whistleblowers were ignored or sidelined. First cracks appeared. Auditors flagged mismatches. Internal reconciliations failed. Intercompany transfers lacked documentation. A handful of emails called out trouble. Those warnings were downplayed. Pressure rose. Answers were slow. The $29 million discrepancy became a symptom. It hinted at misstatements elsewhere. Hidden losses began to surface. Stage 2 followed fast. Restatements arrived. Tens of millions were written down. Then hundreds of millions. Assets were revalued. Goodwill evaporated. What looked like growth became overpayment and waste. Creditors noticed. Covenants tightened. Interest costs climbed. Liquidity fell. Stage 3 was the cash squeeze. A $30 million cash gap turned into panic. Banks cut facilities. Counterparties withdrew support. The company scrambled to raise cash. Assets were put up for sale under pressure. Fire sales followed. Valuable units sold at steep discounts. Jobs disappeared. Suppliers went unpaid. Communities that relied on the company felt the shock. Stage 4 was system failure. Markets lost faith. Leadership could not refinance. The board faced margin calls. Administration followed. Equity holders were wiped out. The $1.3 billion headline number was realized. How did a $29 million secrecy become a $1.3 billion disaster? Because concealment spreads. Because leverage magnifies misses. Because markets punish uncertainty faster than fraud can be contained. The human toll was severe. Pension pots shrank. Longtime employees found doors closed. Retail investors who trusted glossy reports saw nest eggs vanish. Small suppliers lost months of invoices. Entire town centers felt the layoffs. Leadership fled the stage. Resignation letters and terse statements replaced confidence. Regulators and police opened investigations. Boardrooms emptied. Public trust collapsed. Forensic accountants later drew lines through transactions. They traced transfers across shells and countries. They found overpaid acquisitions. They found early write-offs hidden as later adjustments. They saw cash move to shore up appearances, not operations. Value was not stolen in a single act. It leaked out through poor deals. It drained away through emergency sales. It flowed to lenders and buyers who paid under distress. Legal fees and investigations consumed millions more. The formal losses told one story. The human losses told another. Retirements postponed. Homes sold. Lives rearranged. The collapse prompted reform. Boards were forced to strengthen oversight. Audits came under scrutiny. Stricter rules for related party transactions followed. Whistleblower protections improved. Regulators pushed for clearer disclosure and faster intervention. Yet reforms are not perfect cures. Perverse incentives still exist. Short-term pride still tempts leaders. Complex corporate webs still hide risk. The case is clear. Unchecked control plus a single decision to hide a small problem can become systemic ruin. A $29 million concealment can trigger a $1.3 billion destruction of value. So who bore the cost? The ordinary people, the employees, the pensioners, the small investors who trusted the company, the communities that depended on its payroll, and who benefited. Creditors and buyers who acquired assets at forced prices. Legal teams and consultants paid to untangle the mess. Not the shareholders who believed in the story. The lasting lesson is simple. Transparency matters. Boards must act as watchdogs, not cheerleaders. Audits must be skeptical. Whistleblowers must be heard. Leverage must be tested against stress, not optimism. The numbers still sit on spreadsheets. 29 million, 30 million, hundreds of millions, 1.3 billion. But the real ledger records ruined plans, lost retirements, empty factories, silent canteens. This failure is not just about accounting, it is about choices, about human decisions made under pressure, choices that multiply when unchecked. A generation of investors grew more cautious. Regulators grew more active. Corporate behavior shifted, slowly and reluctantly. The story ends with a simple image. Once thriving offices, now dark. Once bustling shop floors, now closed. A town that relied on paychecks and pride, now adjusting to a smaller world. Ask this before the next deal is signed. Who carries the risk? Who watches the watchers? And what will we do the next time a small number hides a much bigger truth?